10 years, 10 years. I don't know. When did you start Timing Research? You were brand new when we.
Yeah, I've been doing the my shows for about 7 years now.
Yeah. So even before then, I think. So anyway,
Yep.
Thanks for inviting me. Everybody, thanks for joining us. Anna, nice to meet you as well. And look forward to working with everybody here today. So we'll talk about favorite indicators. And of course, it's not enough just to talk about favorite indicators, but how we can use them and how we can use them to improve our lives. This time in the world, I think trading and how to establish second incomes and other opportunities are more important than ever with the pandemic around us. So it's a good time to have this discussion. As everybody, and always we do, the disclaimer is pretty standard, just for informational and educational purposes only. Doesn't account for, doesn't include investment advice. You have to make your own decisions, and that those are up to you. You know how you invest, and you should consult a investment advisor before investing money. Leveraged inverse ETFs have their own risk. Those are widely known, but if you don't know about them, please study those before you do use them. They are complex products and don't work like regular ETFs. And then options is a key one. We do a lot of options trading at TradingOutLoud.net, so this is an important one for you to understand that this is not appropriate for everyone. There's always substantial risk of loss with any kind of trading, particularly with options trading. And so it's important to, I always recommend don't trade with money you can't afford to lose, and to understand what you're doing in paper trade before you actually put real capital at risk. So we're going to talk about VIX. This is about favorite indicators. VIX is by far my favorite indicator. It's nobody has a crystal ball. Nobody has a way to tell the future, but the VIX index is about as close as you can get. We'll talk about 4 favorite ways to use the VIX. The Ichimoku Cloud, if you're a futures trader, you're probably familiar with that. Not widely used in equities or option trading, but we do use it. We find it to be valuable. We'll talk about where we are now in the markets, and then, of course, indicators are important, but then how to use indicators, applying them to strategies is the key takeaway from this, and how to actually make this useful for us. We'll talk about VIX options. There's time to buy, time to sell, and then putting it all together again. So let's talk about the VIX overview. I mean, it gets some publicity, and it's widely known, but widely misunderstood. So it's the CBOE Volatility Index, which shows the market's expectation of 30-day volatility. What makes it unique is it's a continuous minute-by-minute snapshot of the expected volatility in the S&P 500 during the next 30 days. So this thing is updated all the time, and it reflects the opinions and the positioning of the people who are considered to be the most experienced traders in the world, the large hedge funds, the trading desks at the big banks. And so if you look at one indicator that would be indicative of what's happening in the S&P 500, or what is going to happen, or what these people think is going to happen, the VIX index would be that indicator. It's had a couple of different iterations over time. The first version was introduced in 1993, quite some time back, and then it was updated again in 2003. So it's known as the fear index. I'm sure you've all heard that, and the reason it's called that is that VIX will go up as fear comes into the market and as volatility increases. And it moves typically inversely to the S&P 500. So that's an important concept to understand, that as fear enters into the market, the VIX will go up, and as fear recedes, the VIX will go down. So it's widely watched and traded by people really around the world, and of course, particularly in the United States. And it's become, the CBOE and the ETF manufacturers are smart people. They figured out that they could actually convert this index into an asset class that can be used for directional trading. It can be used for diversification. It can be used for hedging, volatility options trading. So, and of course, that's how all those people make their money, is by people like us using their products. So the index itself has no value, of course. You can't sell it, and it doesn't pay dividends, but it has become a widely traded, let's call it an asset class. So if you go back 20 years, you can see some things on this chart about VIX. It goes from 0 to 100. It can't go higher than 100 or lower than 0. It's mean reverting. You can see about 20 is the average. 20 to 25 tends to be the median point of the VIX. And if you try to trend follow this, it's generally not effective, but there are ways to trend follow it, which we will talk about today. A couple of worthwhile areas of notice that in 09 there during the big meltdown, it got up to 90, and then it later got up to 50. I don't have an updated slide here. I just noticed that. I apologize, but just recently got up to 60 during the pandemic in March. We'll have a better picture of that later. So what can we make from this? Well, it's the old saying, markets will fluctuate, and they certainly do. And the VIX will certainly capture those fluctuations. So how do you trade the VIX if you want to do that? So if you're a futures trader, you can trade VIX futures. That's pretty straightforward, just like you would any other future, oil or gas or the mini futures, any of those things. You can do VIX options. Those started in 2006. They're listed on a regulated exchange. You can do them at Charles Schwab or TD Ameritrade or wherever your broker is. People use those as speculative tools or as risk management. And so lots of ways to use a VIX option. If you have long stock positions, you can hedge those by buying VIX puts. And you can also speculate with VIX options all kinds of different ways, buy puts, buy calls, credit spread, diagonals, all the different kind of ways that you can trade options. And then there are VIX ETNs, long, and they get into that both long and short. And you cannot directionally trade the VIX index itself except as a futures trader. So if you want to make a bet that VIX is going up, it has to be through a VIX ETN or through an option strategy, a bearish or a bullish option strategy. So let's compare VIX to the S&P 500. So the VIX is the red and black candle charts. The S&P is the black squiggly line there, and you can see how they move inversely to each other most of the time. That's just what we discussed earlier. That is just the way it works, and as you can, it's very predictable. And you can't count on too many things in life, but you can count on the fact that VIX and the S&P 500 will almost always move opposite to each other. If they don't, then that becomes a divergence, and that's something, of course, that should catch your attention as a trader, that VIX doesn't believe what the S&P is doing, and typically VIX will be correct. Now, there's a wide range of discussions. Some people say VIX is predictive, others say it's only reactive. And like we just discussed a moment ago with divergences and other techniques, you can use it as a predictive indicator. And we'll see that in just a few minutes. Yeah, as we said, nobody has a crystal ball, but the VIX index is pretty darn close. So look at a couple of simple trading strategies that you can use. And these are no secret, I don't think, to anybody. RSI is on every stock trading platform there is. And all these are from stockcharts.com, by the way. And I think most of you, you wouldn't be here if you weren't experienced traders and know something about the topic. So when RSI becomes overbought up in the 70 range, we know it's overbought. When it becomes oversold, it's down in the 30 range. And typically that will precede or a reversal. So you can see where we circled the green points where RSI was overbought. And then down on the chart itself, you can see how subsequently VIX declined. So those are pretty good reversal signals that you can take a look at and say, okay, well, it's either 70 or 30, so I'm thinking it's going to go up or down respectively. And you can see that's pretty consistent. It's a real simple way to kind of figure out what might happen next. The one caveat here is the old saying, markets can stay overbought for a long time. So if it's at 70, it will at some point go down, but it may not be tomorrow or when you want it to. So to tune this up a little bit, there's a 2-period RSI. So instead of using the 14, which is the default on every stock chart program you'll see, you can go to a 2-period and you can see it becomes much more active. And this is good for people who want to scalp or do short-term options positions. You can have a pretty predictive look at the next direction of the VIX index. And this, of course, works for anything that you're doing. It could be for an ETF, for the Dow, for a stock, whatever you might have in mind that you might want to trade. So again, they can stay overbought for a long time, but when you're in those overbought or oversold ranges, you can count on a reversal, at some point. Number 3 is point and figure charting. This one is sort of arcane. It's not widely used anymore. I like it a lot. I'll just talk about this for a few minutes. This was actually used long before the age of computers. Back in Charles Dow himself used a similar strategy to this. And what it does is it tracks the highs and the lows of a particular index. Of course, we're looking at the VIX here. And it takes out time, it takes out volatility, it takes out all the noise. This is strictly supply and demand. And if you're interested in studying this, it's a pretty fascinating subject. I'm not a salesman for StockCharts.com, but they've got a great chart school there that goes through all this. And there are several books. You can go on Amazon and really study this particular methodology. But as you can see, it really makes things simple. If it's a column of X, demand is in control. There's a column of O, supply is in control. And you can see where support and resistance levels are. For instance, here at 19.5, this X, that would be a resistance level. And the 16.5, where this O is, that would be a support level. Longer term traders will look at the blues and the reds. The blues are longer term uptrends, the reds are downtrends. And then price action is determined when you get a breakout. So if this X were to go up here and break above this X over here, above 95, then that would be a new breakout indicating a resumption of an uptrend. So it's pretty cool. There's a really clean way you can set support and resistance levels. And if you compare it to a conventional chart, you'll see that it's easier to read in many ways, takes out all the noise, and is quite accurate. And then finally, MACD. Everybody knows about MACD. Personally, I haven't had a lot of luck with MACD. It tends to lag, but some people swear by it. And there are lots of ways to use MACD, with divergences and then comparing them to support and resistance levels. So again, if you want to become a MACD specialist, I'm not your guy, but there are plenty of people out there who can teach you how to use MACD in a trading strategy. And these are all real simple things that are not hard to learn, but that can give you an edge in the market. And of course, we're all looking for edges. And in my view, is simple tends to be better. So now I'll move to Ichimoku Cloud. This is, again, if you're future traders on this call, you've seen this before, I'm sure. This one, I wish I'd invented it myself. This is a very innovative way to follow market trends. So starting from the left, that the lagging line, it's called the Chiku line, the green line. This would be a longer term moving average. So say if in a traditional program, you can compare that to a 200-day moving average. Then this fast line, the Tenkan-sen red line, that would be a shorter term moving average, let's say a 9 or 10 or 8-day moving line. And the slow one is a blue, that'd be more in the, say, the 20 or, depending how you set your charts, 20 to 50-day moving line. And then what makes this interesting is this cloud itself. So we'll talk about this in a minute, but the cloud will actually indicate the market direction. So the light blue cloud here is an uptrend, then it goes into a downtrend with the darker cloud, and then an uptrend. And if you note carefully here, the bars stop right here, but the cloud projects ahead. And so this is one of the few indicators, most of the, every moving average is in lagging in a sense as a trend following indicator. This particular one will project ahead. It looks into where it thinks the future will be. And the wider the cloud is, the stronger that uptrend in this case would tend to be. If you look here, this uptrend started back here, and the cloud was being built out here. So you have a fair amount of confidence this is a strong uptrend. Same here now, you can see it's narrowing, so we can say that this uptrend is starting to lose momentum. And again, you can use this particular indicator any time frame, any asset class, anything, hours, minutes, days, ETF stocks. It's a really versatile indicator. So we'll get into it a little bit deeper here. So that blue line or the fast line we talked about, the Tenkan-sen, the Ichimoku. So that's an average, the highest high and the lowest low over the previous 7 to 10 day time period, 7 time periods. And I mentioned those can be minutes, days, or week, however you put those on your chart. So that would be let's call it a fast moving average. Then the red line is a slow line, the highest and low over a longer period. That could be 20 to 50, again, how you use it. So if you compare it to normal trend following, you'd have, price breaks above a particular line, then that would be a buy signal, or they can cross, that would be another buy signal as well. And then the cloud is that body that depicts more significant support and resistance and the trend of the underlying price. And this math gets a little complicated. I'm not a math person, but it's the high-low average over the last 26 and 52 two-day periods. So that will actually act as support and resistance. And a thinner cloud is less support and resistance than a wider cloud. So if you look at all this, the way this works is, so if you come back here to the beginning, we see this, we've been in this bear market here. And then the prices turn up, the lines cross. When you go above the cloud, that's a strong buy signal. So the strongest buy signals of all are when price, the red and the blue and the green are all above the cloud. Then you're in a very strong uptrend. The initial buy signal would be this initial cross of the two lines. And that usually takes place below the cloud, and price will be below the cloud. So as this goes, it becomes a stronger buy signal that you would have more confidence in. So it really is it gives you a very clear picture of the market and what's happening. So there's a lot of different strategies, and again, you can adapt it to your own style. That's what's cool about this. But the basic principles are, as we talked about, so when price is above the cloud, then you're in a bull market. When it's below the cloud, you're in a bear market. And then those blue and red lines, I use those as early buy points or stop loss points. They're less reliable. They can reverse, but on their own, you can start to take positions when they make those crossovers. And then you can also use those as stop loss points. If the price comes back down through a red or a blue line, that would be a time to get back out. So if you're interested in this, especially if you're, I wouldn't even say especially if you're a futures trader, for anybody, this is one that's worth taking a look at because it's easy to learn. It sounds a little complicated, but it really gives you an insightful view of what's happening in the markets. So we use a version of that in our options trading. And we use them particularly for credit spreads. We do a lot of credit spread trading in VIX and SPX. So where are we now? That's what we're really here to find out today. So this was 28th of August. And so here's VIX. So if we start at the top, RSI is below 50. So you can see it's been declining. MACD has been mostly flat and just on a smidge of a buy signal, just a little bit. And we look at rate of change. If you want a pure momentum indicator, this would be the ROC. So it's just barely positive. So you see that VIX has been negative, for quite some time here since July, and it's just now turning positive. And of course, you can see with all of these, MACD and rate of change and RSI, that they got real high during this the COVID when the stock market melted down in March. Of course, VIX spiked up higher. So if you come down and look at the price itself, you can see how this works. Here's 2020 where it started. VIX was well below average down in the teens. And then the COVID hit and zoomed up. The thing about VIX is it'll make these huge moves. It went from 15 to 85 in just 6 weeks or so. And then it turned back pretty quickly. That's real typical of how VIX works. Even back in the big meltdown of 2008 and 2000, it doesn't stay elevated for very long. But it does give you some real options for trading, making directional trades along the way. For instance, so this is a 10 EMA, a 20 EMA. These are charts that everybody's more familiar with. And then the Keltner channel. So you can see down here, it was on a sell signal, had a little buy signal, broke out, didn't really go anywhere, got stopped by the Keltners, came back down. And then when the pandemic hit, it just really took off and this crossover stayed on a buy signal until up to here. So that's at about 55. And this thing started at 15. So I mean, that's a significant move in 6 or 8 weeks. That's pretty typical how VIX works. Then, of course, it turned south and kept going down, and here we are today. So, interestingly, and this is actually quite interesting if you look at this. So, 22.96 was the price on the 28th. And if you look at the 10-day and the 20-day, the 10-day is just below the 20 EMA. So, and it's turning up. So when this crosses, of course, the standard crossover, the 10 would cross the 20. That would be your first hint that maybe VIX is, turning north. Of course, that would not be a very good trade because you can see how these things, unless they're fulfilled, they don't go anywhere. So you'd have to confirm this either with a breakout above the Keltner channel or say above 35 before you actually commit a capital to it. But it is a little bit of, let's say, an early warning signal that right now, there may be a change in the weather ahead for the S&P. And of course, this is what next. So let's look back here in time and we can sort of look at what happened in 2020. So back here, this first blue line, we had this little buy signal, the 10 crossed the 20. The rate of change went positive. The MACD had a little bump positive there, but didn't materialize, went back down. Then here was the significant one, took off. And this black line, by the way, is the S&P 500 during the pandemic meltdown and then that V-shaped recovery here in mid-March. But if you notice right here, this crossover preceded the decline in the S&P 500. So that is a pretty good early warning indicator, not by much, 2 or 3 bars, that maybe something is going to change. And same with rate of change, and it beat MACD by a day or two. So it is a bit of an early warning indicator there, certainly. And referring back to that previous slide, maybe, and again, it's just a maybe, we're in the same type of spot right now. So history unfolded, the pandemic took hold, we had this big 3-week meltdown. It's like the shortest bear market in history, right? Then it turned, and then you can see, we're still getting slammed here, and then it turns back up, and it goes up, and then right here, here's a sell signal on the early part of April, and that was the end of the stock market meltdown. VIX started declining, S&P started going up. So this would have been a sell signal on VIX, buy signal on the S&P. And then again, now here we are again in this interesting place where we're very close to having a crossover going the other way. So we just have to see how that unfolds. I mean, nobody has a crystal ball. We go where the markets take us. We don't try to predict, and nobody can do that successfully. You might be able to once or twice, but not over the long term. So what does Ichimoku say? So here's VIX on the Ichimoku. So this is a bullish equity environment. VIX is way south of everything, south of the cloud, south of all the averages lines. Still on a sell signal, but we see the same thing here, that the fast blue line is about to turn up and cross the red line. If that happens, then that would be the first precursor of maybe a change in direction for VIX and the S&P 500. And of course, you can see back here during this meltdown what this looked like when VIX took off and stocks went down. So you look at a couple of different indicators across different time frames, and you can get a feel for what things are looking like. So let's put it all together now, because indicators by themselves are fun to look at, but they don't make any money. We're not trading just for fun. We're trading for whatever reasons you might be trading for. And I think, as I mentioned at the beginning, in today's world, and maybe in the world ahead for some time to come, I think it's more and more important that people, whoever you are, wherever you are in life, become more self-sufficient. Obviously, it's people have been thrown out of work, lots of businesses going out of business forever. And so this is one way that can certainly help you wherever you are, if you learn what you're doing and take some time at it to improve your retirement, or to improve your income, to build your net worth, whatever your goal, your personal goal might be. So we're going to talk about VIX options here briefly. We mentioned they started trading in 06. They can be used in any kind of securities account and as risk management or speculative tools. And you can do options on ETNs. You can do options on the VIX index itself. And you can also do options, of course, on all the big stocks. And the FANGs, of course, are the darlings these days. But the interesting thing about any option trading is that you can do it within an IRA. And so that becomes a tremendous advantage for people, because we all tend to have most of our capital in IRAs typically, and you have the tax advantages that are there, so that these would be otherwise short-term gains, but within an IRA there are no gains at all. Of course, they're not taxable until you withdraw them. So we've really focused on options. We focus on VIX options, SPX options, and then also the FANGs. And those are, we found, the best way to trade these directional VIX moves, because, as I mentioned, unless you're a futures trader, you cannot actually trade the index. These are highly liquid options. They benefit from time decay if you're a seller. Of course, if you're a buyer of options, time decay is your enemy. If you're a seller, it's your friend. And we do both, depending on what's happened. There's a time to buy and a time to sell. And VIX will tell you that. Back in that previous chart, that VIX has been going down for months. That's a time to sell VIX. And if it turns north, then that would be a time to buy. So different strategies for options are vertical calls, credit spreads. And those can be vertical calls or puts. And you can use ETFs like SPY, or you can use SPX, the cash contract itself. And then you can do a credit or a debit depending on market conditions. And that's what you need to learn, because they both have a time and a place. But you do not want to trade an option the way most people do it, which is to buy a call or a put that's far out of the money and hoping to hit a grand slam, a home run, because the odds are absolutely against you. And So you want to do the opposite of what everybody does, and that's to use these indicators to set up high probability trades that are in your favor. So when we do these spreads, you have the advantage, or you have a known amount of risk, and you have, we look for 80 to 95 probability of success, and Thinkorswim will tell you that, or whatever program you're on. And selling automatically gives you an edge because, there are all kinds of different studies that say, between 70 and 85% of all options expire worthless. So you have a built-in 70% advantage. They say if you're a seller of options, you become the house. If the stock markets are a casino, then you become the house if you're the seller. Then you are the sucker if you're the buyer. If you think of it as an insurance company, you're selling insurance, portfolio insurance. You collect premium, and sometimes you have to pay a claim. But the key is you don't have to be right about the market direction. As an option buyer, you have to be right about the direction, the price, and the time. But you don't have to do that when you're a seller. And all these we tie to the fear index. I mentioned if I have one favorite indicator, we start with VIX. So we can use debit spreads in volatile markets because that's when we have the best chance of making money, and then credit spreads in a calmer market. And of course, weekly options are a whole new, they're not that new anymore, but they've revolutionized the way you can option trade. Most options weeklies expire on Friday. Like if you're going to have, a Netflix or an Apple or one of those stocks are on Friday. The SPX cash index has Monday, Wednesday, and Friday expirations. So you have 3 opportunities a week. You could trade the SPX and 1 expiration a week for let's say the FANG stocks, because those tend to be high price but a high premium. So it's really easy without a lot of work you could make. Let's see, we average about 5 to 7 trades a week, and they're all short-term type trades. And actually, some of them, as we'll talk about in a minute, you are really a day trader. Like on Monday morning, you can open a credit spread on in the SPX, a call or a put, depending what you think the market's going to do just that day. It runs for 1 day. And if you're right, then you collect the premium at the expiration at the end of the day. You can do that particular trade 3 days a week. If you want to go longer, you can go out till Friday. But so you have, the cool thing is you have a lot of opportunities to profit. So why are you doing this? You want to build your net worth, monthly income, retirement? Do you want to be a full-time trader? What are you looking for? You have to decide that first, because if you don't have a goal, it's the same old thing. And if you don't have a map, a direction in mind, a destination, any road will take you there. And so it's quite important that you figure out what you want. That's number 1 thing. Number 2 thing is figure out your risk tolerance. As we mentioned, that you have to just understand that this is still a speculative type endeavor. As much risk as you take out of it, there still is risk. So, where's your stage in life? Are you retired? Are you young, starting out? Where are you? That's an important consideration, to set the framework for how you're going to proceed and what your goals are. But in the weeklies, as we talked about, the SPYs have 3 days a week. The VIX are 1, so you get a couple hundred trades a year. So that's a real advantage. Because if you're wrong once, it's easy to come back. They have short time exposure. There's terrific advantage here in several respects, because I don't know what's going to happen in a month or 2 months from now at the S&P, but it's a lot easier to figure out what's going to happen today than even just a few hours from now. So that cuts down your time risk dramatically. And of course, time, as we mentioned earlier, can be your friend or your enemy, no matter what kind of option trading you're doing. So that's a key thing. The other thing about time is, if you're an option seller, is theta, which is one of the fancy Greeks, which really just means time decay. Every minute that passes, that option loses value. And if you sold it, that means that you're making money. So these weeklies are a terrific invention. It used to be just monthly expirations. And so for people like us who are interested in trading options, this is a really a new opportunity. And it gives you consistent income opportunities. If you're selling an option, you don't try to hit a home run. You're just looking for singles and doubles and be steady and control your risks. You don't take big losses because people say that selling options is like picking up nickels in front of a steamroller, and it is. If that short option goes in the money, you'll get killed. But you do as many things as you can to keep that from happening, and we do that through what we're just talking about here: short time exposure, using those indicators to determine direction, looking at the delta. How much the pros think that the pricing thinks that option is going to change in time. And we can do 1, 2, or 3 day trades. And that's what we do. And that's what you can do. That's what everybody can do. I mean, these are widely traded, widely liquid markets. And so you can do directional trading with these vertical debit spreads. So this means instead of buying a call and just hoping it goes up, you can buy a call. Let's say you think it's going to go up. You can sell a higher call. So your return is limited to that premium between those 2 points. But you also pay for part of your purchase by selling that higher call, and it becomes a debit spread. So, and you can do that over and over again without getting too fancy. There are lots of fancy, really complicated ways to do this, but you don't have to be complicated. And the other thing is, if you're going to buy an option, the closer you are to buying one that's in the money, the better off you're going to be, because the closer it is to the underlying asset, the more it will trade like that underlying asset, and they're more expensive. So everybody tries to buy cheap options, but that's as we mentioned, a high risk, low probability outcome. If you buy one close to the money, and if you're right on the direction, you have a much better chance of profiting. So your key points here: you have to manage the risk. We've talked about that. That's both money management and directional and all those things that you use these indicators for. You have to be able to manage the trade. The main thing is not take a big loss. So you have to have a known amount of risk. You have to have stop losses that work for you. And of course, these are liquid markets. They're easy to manage, high probability of success, short holding periods. And if you want monthly income, they'll generate that. If you want to build your net worth, they have the potential to do that as well. All right, so we've talked about, I think, most of these things, the probability of success. And here's the key, indicators. I haven't been able to watch this whole program, but I could guess that almost everybody on this program is talking about how to forecast market direction. When you're selling options, you don't have to be right about the direction. It's exactly the opposite approach. All you have to do is think about where is the market not going to be in a certain period of time, like by the end of today. And then you can use support and resistance levels. You can use those indicators we talked about and figure out a very high potential position, high probability position to take. And again, we talked about the time decay. So you get paid when the position is open. When you sell the spread, the money goes into your account and it stays there until it expires or until you close it. All right, so I don't know where everybody is in the educational process, but Investopedia says when you simultaneously buy and sell an option with different strike prices, that's a spread position. And when the one you sell is more expensive than the one you buy, it's a net credit, and that's a vertical credit. And net debit is the opposite. The one you buy is more expensive than the one you sell. So, and again, this is substantially different from what most people do, which is just buying a call or a put. And you can get really fancy with these spreads. You can do diagonal spreads. You can do butterflies. You can do, I don't even know what half those things are. But you don't have to get fancy, which is the point, because usually what works best is if you focus on one thing and do it well and become really good at it, that will be your best chance of success. If you look at a football player, a guy who's a quarterback, just really focuses on being a great quarterback. He doesn't try to be a good wide receiver or a linebacker or a place kicker. He focuses on one thing and becomes an expert at it. The same is true here. So I would say to everybody, indicators are important, strategies are important, but the most important thing is that you find something that suits you and that you can stick with over time, because if you can't, you're not going to be successful. And that typically is what happens to most people. They try one thing, works okay, then they have a loss and they move on to something else. They just hop around from thing to thing, and it takes great discipline to be successful at this. And it takes great confidence. And to have those two things, you have to have something that matches everything about you, your personality, your lifestyle. Do you have a job? What are you doing? And then find that thing that matches, and then be consistent with that and become an expert at it. So we talked about that vertical credit spread is limit risk, but that doesn't mean there's no risk. So there's trade management, money management. It's just an example of one we did on the VIX vertical credit spread back in June. So we made $420, a 9% gain over 47 days, which would work out to 71% a year. But you could lose $4,500. So it's a roughly a 10% return, like I said, 9.2 in 47 days. But the key is you definitely do not want to get down to that 45.80, because that's going to take a long time to get over. So that's the trade management, number one item. The second item there is money management. And that would be if 9/11 happens this afternoon, or if there's some kind of a black swan event, that 45.80 loss could become a reality. So most people enter into trading thinking, well, how much can I make? And the way you really want to do this is think about how much can I lose, and then set up your trade based on that. So here's what we're watching now. Of course, the coronavirus. I mean, that thing. It's every 100 years of the pandemic, I guess, and nobody knows how this is going to turn out. Obviously, the stock market doesn't seem to care right now, but if you look at the underlying economy, I mean, there's been some significant damage, and when some of these government supports end, I mean, nobody knows. I certainly don't have a crystal ball. Is it V-shaped? Is it L-shaped? Is it U-shaped? Is it a flat line? What's going to happen. But we don't have to predict, because we have the VIX that is going to tell us. Volatility, you can see how it looked back in March there. Now it's calm. Is it going to come back? We don't know. Elections are always a factor, and we're watching that. And again, this one will be one of the most interesting elections in history, probably, with the mail-in ballot and all those things that are being discussed. And then, of course, seasonality. We're ending summer now. Labor Day is coming up. September, October is always a change in season, not just on the calendar, but in the stock market. If you look at all the crashes in history, I mean, pretty much September, October is when they happen. And then there's the old Halloween indicator that October 31st, and after that, then the probability is more for a bull market. So I'd say right now, these next couple of months are particularly potentially risky and worth really paying attention to what's going on. So I took these little factoids off CNBC yesterday or a couple of days ago. These are really interesting. And again, this doesn't have much to do with trading, but we don't trade in a vacuum. Every number you see on that chart, that's all you need to know about that stock or that thing, that index, whatever it is, but they are also connected to fundamentals. So if you look at this, so the S&P 500 is up 13% since June 30th. I mean, that's wild. NASDAQ, I think, was up 33% this year. So these are historic kind of numbers. The S&P was up every day in August, but for 4 days. It's more extended above its 200-day moving average than at any time but one in the past decade. So, of course, the higher it gets above the 200-day moving average, that would indicate, the more overbought it is. And then there's an indicator known as the put-call ratio, the ratio of puts to calls, speculative option buying. So that's at lows last seen in 2014. So that indicates over bullishness and complacency. And you read a lot about the Robin Hood traders and day trading. Google searches has gone vertical since the pandemic. People are at home with nothing to do or out of work. So we're in a very bubbly environment. I mean, there's just no way to minimize that fact. Then this Bank of America global strategist says if the S&P passes 3630 by election day, which is just 3.5% from now, between now and November, it'd be the biggest rally in speed and magnitude. Biggest summer rally since 1987, according to Bubba Horowitz. I'm sure you've seen him on CNBC. He's the options guy. And so when was 1987? Bubba points out, everybody remembers that after that biggest summer rally came Black Monday on October 19th, 1987. I can remember that day. I'm old enough to. I'm sure some of you can as well. And that day, the Dow was down 22.6, S&P was down 20.4, and the NASDAQ actually failed. The computers in those days and the phones and all the infrastructure couldn't keep up with the volume of trades, and the market system itself actually did fail. So, I mean, history doesn't repeat, of course. And some people say it rhymes. You've heard that before. But all these things are at least worth, perking your ears up, paying a little attention to. So as I mentioned, we have a program that we call VIX Trader, and that's really an educational program and training program. We do VIX options, the SPX, and the FANGs. Of course, the FANGs are the darling stocks. I think I read the other day that Apple is now or about to become more valuable than the entire Russell 2000 index, and that's amazing. It's worth more than a lot of countries. But the FANGs provide terrific option trading opportunities. We get deeply into the VIX index, of course. That's the keystone of what we're doing, the fear index, how it works. And we trade these things. And then just a lot of ongoing education and the weekly options. We do a Saturday trading room. We don't do trading rooms every day. I guess we should, but we don't. But we do one on the weekend. We sort of summarize what's going on and just use that when things are quiet and the markets are closed to educate ourselves and to talk about what happened and what might happen next. So we talked about coming back to the beginning, figure out what you're trying to do. That's the number one thing. And then number two, who you are. So our goals personally are monthly income, doing 5 to 7 trades a week. And we have these continuing expiration dates leading to monthly cash flow. We almost exclusively sell vertical credit spreads, calls or puts. So those are known as bullish puts or bearish call spreads. But there is a time when we think back to that VIX chart. When that VIX starts to spike, there's a real opportunity then to directionally trade debit spreads into VIX for that short period of time when VIX is climbing fast. And as we pointed out there, that might be coming soon, but again, I don't know. And neither does anybody. So we start new trades all the time. We do these by email. We're going to set up a text, phone text thing. That'll be in the next month or so. We have the trade itself, exit points, entry points, and these credit spreads. I have to make a little sales pitch, of course, here. David said I could, so I apologize. But if you're interested in getting to know us better, there's a little $9 mini course that has some videos with it, and that you get 2 weeks of this alert email. There's a free ebook. If you go to the website, this annoying little pop-up will show up, and you can sign up for the ebook. And then if you just want to go there and sign up, we do 2 daily newsletters, and those are free, of course. One is for the stock market generally, and then one focuses on VIX itself. And then this weekend trading room, we were doing it on Saturday, but people, nobody showed up because nobody, I guess, wanted to be there on Saturday afternoon. So we moved to Sunday night, and that one has been very successful and well received. And it's on one of those webinar software things, and there's a chat, and it's really been cool. Those are growing in popularity, and it's a great way without spending money to learn, a lot about what's going on, at least about what we're doing. So see if I can click on this thing. What can we do here? Click on the $9 course. Said I can't do it. Never mind. Okay. I think that's it, David. We're a little early. Maybe we have time for some questions.
Yeah, you have about 5 minutes left. Does anyone have any questions?
or discussions. I'm always willing to learn. You learn every day. If you stop learning, that's not a good thing.
Are you able to see the chat, John?
No, I should, maybe if I come out of this full screen thing, I can see it. I don't know. Let's see. Let me go back to let me go back to the Zoom.
Well, here, I'll read one of the questions. Are debit spreads low probability?
They're lower probability because you have to be right about three things, the price, the time, and the direction. Because you can be right about one or two of those and still lose money. The thing that makes the debit spread more attractive than just buying an outright put or call is that it allows you to pay for part of that by selling that option, so that you can you pay a lower price basically by buying that option on sale. So I would say they're lower probability than a credit spread, but they're higher and better potential return than just an outright call or put.
Okay. And someone else asked about the link. I put that in the chat, but it's tradinggods.net.
Yeah, if you just go there, tradinggods.net, that takes you to everything that's up there. And thank you.
Do you ever use the EM, the expected move, in the pricing?
No, I don't. If somebody would know something about that, please educate us, because no, I don't use that. I use Delta, and I use, of course, the indicators that we talked about.
Okay. Are you able to see the chat now?
Let's see. I see. Let me see.
You should.
I see.
Oh
yeah,
see
I've got
the
it.
Zoom.
Okay. Yeah. Okay. I see Sean's offer, Jennifer's.
Rick had it. Rick just posted the question.
All right. Let me look back up here.
It's at the very bottom.
Okay, Rick. With VIX, there's one to trade on versus option. There's thousands to choose from. Okay. So there is one VIX index. There's also a bunch of VIX ETNs. And then there are certainly thousands of stock options. We do stock options, those Friday expirations. We do 1 day expirations on Friday morning. And we also do 2 and 3 day, say you open a position 2 or 3 days ahead of Friday. All of the stock options that I know of expire on Friday. And that's a very cool thing, because then Friday becomes like a payday. And so it's a real opportunity there. And the FANGs particularly are so hot now that you can get some super premium when you're selling those on Friday. Mark asks, which indicators do you use for money? I'm not sure I understand what that question is. Do you get that one, dude?
Yeah, I'm not sure what they mean. Maybe they mean for currency trading? I'm not sure what.
No. Oh, money flow. Okay. So I don't do money flow. We do momentum and that rate of change, and the MACD are the two we use for that. The rate of change is a pure momentum indicator. And of course, that's what you're interested in on these short-term positions, is what the short-term momentum looks like. And we can use daily, hourly, 2 hourly. We don't use minutes, but let's say daily, hourly, and 2 hourlies. Can you do options in Forex trading? I don't know. Does anybody know the answer to that? I know you can do options in commodities trading, but I don't know about Forex trading. Jennifer says, okay. All right.
All right.